and we are deploying them at scale. Let me start with how AI is shaping the way we work. Take Aqua, our email to quote AI. It's already live in 4 countries and has slashed quoting time by nearly 60%. We're doing about 20,000 quotes every month. That's customer delight delivered at speed. Elma, our operation assistant, it's like having a digital co-pilot guiding our teams with the latest SOPs, ensuring compliance while keeping execution fast and flawless. And finally, Sarah, our AI for customer retention. Deployed across 25 plus countries worldwide, it uses AI and machine learning to engage customers smartly. And in our early pilots, attrition dropped significantly amongst customers that we connected using Sarah. That's loyalty powered by intelligence. But we didn't stop here. We embedded AI into the very heart of sales, pricing, operations, and finance. For sales, Glimpse AI gives teams instant customer insights, enabling sharper consultative conversations. Marketing automation ensures accuracy in targeting, and pricing intelligence recommends the smartest trade lane prices with multi-factor precision. On the operations and finance side, AI is quietly, sorry, go back one slide. Yeah. On the operations and finance side, AI is quietly rewriting the playbook. Era AI captures inquiry emails and drafts perfect responses without a human in a loop. Booking AI converts booking seamlessly with human validated accuracy. Document AI and invoice intelligence transforms unstructured chaos into structured clarity. And Fact, our finance AI, delivers real-time insights, deviation analysis, and instant alerts. So leaders act proactively, not reactively. Together, these AI engines form what I like to call, the digital nervous system of our enterprise. And at the center of it all, as you heard in the previous speakers talk about it, is EQ360, our flagship customer-facing digital platform already acclaimed as best-in-class worldwide. With 2,400 plus trade lanes, it offers instant quotes, bookings, dashboards, track and trace, truly connecting any corner of the world to any other. The trajectory ahead is even more compelling. We are introducing predictive visibility, advanced personalizations, and sustainability with CO2 visibility embedded in every quote and booking. Furthermore, EQ360 is evolving into a growth engine, extending into trade finance integration, new customer segments, and adjacent services such as domestic trucking, FCL, and air freight. In a sense, it is not merely a digital tool, but a strategic ecosystem. Our ambition is clear: to integrate speed, intelligence, and security into the DNA of logistics, creating solutions that are smarter, faster, more resilient, and sustainable for our customers, while delivering long-term value for shareholders. We're not simply responding to the future, we are shaping it thoughtfully, at scale, and with purpose. Thank you.
I now call upon Mr. Ravi Jakar to take the stage. Sorry, my mistake. I now call upon Mr. Stephen Dunn, Global Finance Director, EQ Worldwide, to take the stage.
Okay. Where's my slide? Good afternoon, good evening. Hi, I'm Steve Dunn. I'm across from Dubai, actually from New Zealand originally, so hopefully my accent isn't too confusing for everyone in the room. But I'm really excited to be here. I'm here to lead a finance transformation for EQ Worldwide, and my role is pretty simple. It's to dramatically lower the cost to serve of the finance function to the business, as well as improve the quality and service delivery to the business. And the really good thing is EQ's got such scale and breadth that it's the right time to deliver the finance transformation. And with technology coming on thick and fast, there's some very strong things that we can do to deliver in that area. Basically, when I started this process, what we analyzed, we divided finance into its 6 or 7 core functional areas. For example, you can look at areas such as AP, AR, GL, FP&A, treasury and tax. Each of those we divide into 3 areas: systems, process, and people. And it's pretty simple. We want to optimize in each of those, as well as having synergies between those sub-functional areas. So the general theme that we want to do, first of all, is I sort of say, build the machine. So build the machine essentially is about deploying world-class technology, and then also bringing in world-class leaders who know what good is to then deliver and optimize in each of those areas. So already in this process globally, we've deployed Microsoft D365, which is one of the best global accounting platforms out there. Comes out of the box with a lot of AI enablement, a lot of integration into analytical tools. At the same time, we've deployed Oracle Hyperion for budgeting and consolidation, which is used by about 40% of Fortune 500 companies to support analytics, rapid reporting, and a very secure business planning process. The second phase, really after build the machine, is actually to look into centralization. And I'll go through some of those functional areas in a second. But the centralization enables us to realize savings, as well as to reduce the cost to serve. But then some of those savings can then be reinvested into other value-added activities, such as FP&A. So looking at some of the functional areas and where we're at, so if I look, for example, at what we call financial operations, which covers accounts receivable, accounts payable, the vision there really is to centralize as much as possible and then to wrap AI enablement around all those core functionalities. And we're already well into that path. We've chosen one of India's leading digital automation partners, and we've already moved a lot of people into our centralized shared service center. And now we're moving into the AI enablement to automate as many core processes as possible. And we've gone live in 3 or 4 pilot countries, and the results are really quite outstanding and quite exciting. I mean, AI is completely transforming what can be possibly done in a finance function. So the next stage then is to take those pilot countries and rapidly expand it around the rest of the world to materially reduce the cost to serve for the finance business. In areas such as we're complementing that strategy with then regionalizing our accounting activities. So the aim is essentially to decentralize a lot of the finance functions around the world, because currently we're quite globally distributed, and then to bring those into 3 regional shared service centers where we can apply scale economies, we can get consistency of outcomes. And once we have scale economies, you can then wrap technology around those as well. So if your finance function is spread around sort of 100 plus locations around the world, it's quite hard to get those scale economies. So the first thing you need to do is bring everyone together and then apply technology. So that's pretty exciting what's happening in that space there. Within areas such as, for example, FP&A, which is really what a modern finance function should be delivering. This is about delivering service to the business to enable the business to drive stronger commercial outcomes. So we're pretty excited in that space too. We've brought in strong leadership in there. We're investing in the technologies, and we're really looking at what AI can do. What Kapil was saying before, it's about getting instant value-added information onto the desk of everybody in the company that needs it, to make better decisions that impact financial outcomes. So there's a lot of exciting things I feel happening in that space, and this is where I see the modern finance function really delivering a lot of value to the business. On top of those areas there's, now that we've built the machine, now that we essentially have strong analytics and we've lowered the cost to serve, we look at some of the other financial areas, such, for example, as tax and treasury management and control. So from a treasury management point of view, there certainly is a lot of opportunity for us. We're strengthening the treasury leadership, and we're looking at ways we can fully optimize working capital. So there's many more solutions on the market today than there were 10 years ago. Some of the ways that we're looking to drive and optimize working capital are by looking at deploying a global factoring program. We're looking at supplier trade credit programs which enable you to finance your payables and receivables. And we're in many countries around the world, and some of those countries it's challenging to get some cash out of, but there's digital innovations and there's methods and ways to start getting more of that cash out of some of those hard to get countries, which we are then bringing into a central pool. Other initiatives that we've achieved recently is we've migrated our business with a global bank. The global bank's enabling us to then have global cash pooling, which means that we can suck all the surplus cash out of those countries around the world into a central hold. That central hold means we don't have to draw down on a revolver on a day-to-day basis. So that's really actively driving daily cash management. So within that space, I do believe that we can add a lot of value to release more cash to the business to fund growth and service any future dividend flows. So yeah, we're pretty excited in that space. Within the tax area too, there's a lot of opportunity for us. I think EQ's grown over the years through acquisition, and we've taken a look at the whole structure of the group, and we're re-optimizing all the tax processes. There's the way the companies charge each other. There's the way the dividends flow in and out of the group with withholding tax. Now that we have strong expertise building in these areas, we're able to optimize and essentially bring in a lot more value from a tax management point of view. So we're very excited in that space as well. And I guess, in other areas too, it's just about finance delivering small wins to the business. So, for example, in a complex freight forwarding operation like EQ, intercompany is a major factor. And in many of the companies I've worked in, intercompany has been a challenge for many companies to solve, but we're deploying technology and AI to mean that we can get rapid settlement and rapid understanding of our numbers, which then means that we have more visibility and control of all the group account and netting processes. And we've just right now launching a global netting portal, which is fully automated. So I think that where we are in our journey, we've got a lot of things happening. We've in each of the functional areas, we're bringing in strong leaders who know what good is. They've had time to then develop their plans, and we're now implementing the plans. So I do believe we're at the cusp of starting to deliver some tremendous value to the business. And as I said, for me, it's personally exciting to build a modern finance function that can be seen as a value-added business partner. And along with that, the final stage is to make sure in all of our countries around the world, we don't really have bookkeepers who just do debits and credits. We want to have leaders in the field and finance who are business partners, people who can help support management to drive commercial results, to interpret numbers in the business, to do storytelling, and then help improve the overall performance of all of our regions in the world. And the word that I like to use is kind of democratizing information. So making sure that the branches of the world have the same quality of information, analytics, thought process as the most senior parts of the organization. So if we can do that, we can, I believe, build a finance function that's a true value add to the business. So thank you.
Thanks, Steve. And basically, if you look back at all the growth initiatives which others spoke about, the cost initiatives, and also all these financial initiatives, fundamentally what that leads us to, can you put the slide, please? Yeah. If you look back at, financially what it means, what are we trying to deliver as a business, as the entire management team? If you look through the last 4 odd years, or rather 5 years, the red line is the World Container Freight Index. That's how volatile the freight rates have been. And naturally, there was some volatility in our gross profit as well, while the volumes remained steady. But if you see what we've been able to do over the last 12 months, and that's been consistent with the efforts, all the initiatives that others spoke about, the freight has continued to be downwards over the last 12 months, but the gross profit has been moving northwards. And that's what is creating the ability for us to drive profitability even in a challenging market. And the very principle that we are trying to apply as a management team is that we drive volume, we maintain the yields, which means that we can expand the gross profit on the back of all those initiatives. And if we can keep our costs in control, and Steve spoke about a lot of these things, shared services, automation. Kapil gave an idea about how every process is being transformed. The cost of operations comes down when we have technology enabling it. So all of these things mean that our gross profit should go up and the SG&A cost should grow at a much lesser proportion. And it's the arbitrage of gross profit to SG&A margin that basically helps us create enhanced profitability. And that's what the direction broadly is. We have tried to put together what our aspiration should be in terms of these numbers, and the presentation is uploaded, so it's available. I'll just broadly say that we believe that we can continue to grow across all the business segments. Naturally, the smaller base businesses would have a higher growth rate, but across all the businesses, we believe we would continue to grow over the years to come by. And from a profitability standpoint, the number should more than double from where we are over the coming years. The way to look at this from a company structure point of view, like we spoke earlier, Allcargo Global Limited, which would be the new listed company for the international supply chain business post the demerger getting concluded, these numbers would basically be reflecting the performance of that entity. And all of this, like possibly what we're trying to do here together is a combination of efforts between the group management team across functions, driving technology, digital, HR, and finance, along with our managing director Adarsh, and also an impeccable team which is driving the international supply chain business in particular. We have functional expertise across commercial, operations, FCL business segments, and then we have 6 regions. That is how the business operates. And each of these regions are like, independent profit centers, driving growth initiatives, controlling their costs, and operating like an independent company, which is a part of the larger enterprise. So that's the structure which basically helps us to work on our plan, strategy, and drive performance. So that's all from our side. And maybe I can invite back Mr. Adarsh Hegre and my colleague Kapil to join in, and we can possibly take up some questions. Please come in.
Thank you, Ravi. It's always a tall order to follow after you. Ladies and gentlemen, we now open the floor to questions. We have our 2 lovely hostesses who are there with the mic. If at all you have to ask a question, raise your hand. The hostesses will come close to you.
Yeah. Hi, sir. My question is about this newly or will be demerged global company. So this US 50% tariff, how much it would have disrupted the trade of this of the businesses?
Are you, sorry, just to get it clear,
Yeah.
you're asking what is the impact of the tariff?
Yeah, on all our the industry.
Correct. So basically, if you look at it, India, of course, does have a little, but if you look at our entire global volume in that perspective, the effect is not going to be much. While I presented something on the screen at that time, there have been new areas that we have already identified to compensate for those small drop that would happen immediately. So you would not see a much of impact. In the immediate perspective, if you look at some volumes, yes, there would have been drop from India on the FCL part of it, the full container load part. There is about close to about anywhere between 50 to 60% lower as well because the tariffs have gone up. In China, if you look at it, from China to US, there is also a drop. But for us, what has happened is from China to other countries in the APAC, the other countries, the volumes have picked up. So there is sort of overlap compensating. So it shouldn't be a big impact for us. In fact, I would look at it that we should have some more impact, in fact, getting more volumes on the LCL because people probably would only, send only small quantities is what I look at it till things settle down.
Thank you.
Yeah, hi sir. Here from the last two days, continuing from Jeffries. A couple of questions. If you can maybe take it back to the previous slide where you quoted your 2030 targets, right? So, just trying to understand, how are these aspirational numbers or are these stated targets that you have? And also, if you can provide some color on the maths behind it. I mean, what is the kind of market share assumption that you had put in on working these numbers on the LCL side or the industry growth side? Maybe if you can provide a little bit more color on that, please.
So fundamentally, we have started with a product-wise breakup. That's how any plan is built. And across product categories, the growth is largely driven by various initiatives, which my colleague Adarsh spoke about. We are entering some new markets. We have started some new products. So all of those initiatives lead to a compounding impact on the growth. So we are not looking at market share expansion in the existing markets where we already have a stable, mature market, like in European markets, etc. We assume the same market share, no expansion there. But there are pockets of opportunities where we are not present. We were entering in, Adarsh spoke about Brazil or some other Latin American countries where we have rapidly grown market share. So we have built the volume assumptions product-wise, which are leading to the increase in the volumes. And as you know, our business is focused on gross profit. Revenue is more of an outlier depending upon the freight rates. So we are hoping that the yields will remain same. We are not looking at yield expansion based growth, despite the fact that, as you increase the door percentage, as you increase value added offerings, as you increase the long haul trade lanes, it should have a positive impact. But largely the assumptions are more volume driven. Volume growth is initiative driven. On the cost side, like I said, there's an inflationary adjustment which you've assumed. And Steve spoke about various shared services that would lead to efficiencies. Kapil spoke about the technology initiatives. So all of those initiatives have been baked into planning inflation offset by initiative net impact. So that's how the profit is just an outcome of that.
Sure. So these are essentially the stated targets. I mean, there's a math behind it, understood. Fair enough. And so secondly, on the initiatives on the cost side, right? There are two parts to it. One, with respect to the manpower reallocation and also optimizing on that front. Or the past few con calls, you're also speaking about reallocating some of the cost to lower cost economies, maybe moving from US to Brazil kind of examples. So where are we on the journey at this point in time? And then from a initiative standpoint, from SG&A to or from GP to EBITDA conversion, I mean, from current ratio, I mean, what is the potential opportunity you look at on the conversion aspect? And secondly, on the finance initiatives, like, is there a certain number identified with respect to loss, either through the dividend flows or centralizing operations? Is there a number that's been identified and potential reduction on that front that you're looking at?
Yeah, so in terms of the operational shared service centers, we have already done that for some of the large countries like US. And we are currently underway for some of the European countries and some of the high-cost Asian countries as well. I'll let Steve talk about the financial shared services, where we are on that. But each of these targets, we have a very clear visibility, whether it's text optimization or shared services. Each of the initiatives is broken down into a specific office, specific number of rationalization on costs. So it's not a high-level approach, but it's a very, very ground-level approach in terms of, it's possibly broken down into maybe 50, 60 initiatives, each of them tracked separately. Maybe Steve, you want to give a color on where we are on the financial shared services?
Yeah. Yeah, so essentially we are already underway with one region around the world, which is the first regionalization, which is full AR, AP, and GL, and that should be largely finalized by end of Q1 of next year. And then following that, we have detailed plans for the other two regionalizations as well. So everything is fully planned out. And it's a matter of sequencing it at the right pace that the organization can handle. If you transform too much too quickly, it adds too much risk. So we'll do one region, then we'll do another and do the rest. But we have very clear targets, which as cost savings, which we feel very confident we can hit.
Sure, sir. Thank you very much and all the best.
Q&A?
Hi, thank you. You mentioned that the current profitability of the business is under pressure given the global situation. So in this environment, how are we doing relative to competition? Like, what would be the profitability of some of the larger global peers at this point? And you also mentioned that from initiatives you want to add new markets. So as you add new markets, would that mean lower utilization and initial losses in those markets? So how confident are you about sustaining margins given new market entry and so on?
Yeah, so I'll share some of the insights and then, let others share onto that. So primarily, as we spoke about being the only global single brand company in the truest sense, many of our competitors are in specific country or regional markets. Now, if you look at our own performance also, it is not secular. We have countries which have operated in the losses in the last couple of years, and there are countries which have demonstrated growth and profits. So what we find is some of these struggling markets where the macroeconomic environments have been complex, some of the European countries, those local players have been under pressure and operating in losses. Now, these are not listed companies, so we tend to get data delayed by maybe about a year sometimes. In September to November, we get the data, and but we do know a lot of industry players have been operating in losses. Among the global peers, there is no exact benchmark, but I would say our sense is that based on how we efficiently utilize our boxes and price our services, I would imagine that we would be among the most profitable in the industry in terms of the current environment. Of course, everybody would be on the lower side, but on a relative basis, as you asked, I think we should be on the higher side.
Yeah, absolutely. I think the other main thing that has kept us, if you look at our yields that we have been able to hold, which I shared during the presentation as well, has been possible because of our new markets, the new initiatives that we have taken. And of course, we've worked on a lot of cost parameters because the selling is, it's market driven, right? The only thing that we can do is the cost. Cost can be controlled by us. By digitalizing a lot of process of ours, the RPA projects that we introduced, the shared services that we spoke about, all this has culminated to holding on to our the numbers well, yield numbers well. Having said that, if I look back, like what Ravi said, within the competition, there are a lot of trade lanes that we operate, which probably they don't operate. And that's one of the reasons that we've been able to better them in terms of numbers, whatever we get. Obviously, I wouldn't want to comment on it. Maybe it's right, wrong. But I'm pretty confident that we are way, way ahead of them. Yes, it's a difficult market, but I think we still have a lot of room to do, and which we are doing, and that has kept us going. Also, if you look at the FCL part of the business, if you look at the share of our market share and globally, if you look at it, we are very minuscule. We might be ranked among 17, 18th in the world, but we still have a lot of room to grow there. And that's one other opportunity that we continue to work on, which keeps us on. Yeah, probably, yeah. Yeah. On the cost of people, cost, how?
How we are managing. Yeah. So good afternoon, everyone. And I think it's a pleasure to address all of you and be here and speak on behalf of the organization. There are multiple initiatives, HR initiatives, people-related initiatives that we have launched in the past, and some of them are already implemented. One of them being a global payroll system through one of the largest payroll provider of the world, which is ADP, which is listed in the New York Stock Exchange. We have engaged them 18 months back to implement the global payroll system. The objective being to have one single source of truth for all people-related costs and have a better transparency and control over the cost. We are very, very happy to say that almost 85% of the project has been implemented successfully with a very good feedback from our stakeholders. And we are having around 7 countries which are already underway to get implemented. End of next year, we will have the entire organization on that. What we will get out of it is, of course, one single source of truth. Second is we will get the full clarity on the cost something that we all are very conscious about. And third is, of course, the better management of all people-related information through single source of truth. Thank you.
Thanks, Nirani. So basically, if you look back at all the things that we have done, if they were not done, on the cost control, outsourcing,